Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, Walmart dropped a huge bomb on us. We're going to talk all about it and show you some charts. Let's dive in.
Trade Genius.
Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening.
So Bob, really interesting, something I don't think I've ever heard Walmart talk about this morning was consumer weakness because, like McDonald's, they're kind of the go-to if all else fails, right?
Yeah, I mean, look, they usually are very careful on how they position things, but they came out and about and basically said, welcome to deflation. Consumer demand is plummeting and it's going to be driving prices down. But, they're not the only ones. I know you have one to mention, but Amazon has stopped, I guess, this massive distribution center they're going to be opening for the holidays. They just basically said it's on hold indefinitely because of they're worried about consumer demand. And then you had FedEx telling their contract pilots, we may not have seasonal work for you. Try to find work elsewhere. And then the first chart I want to throw up here is that on all the earnings reports, the mentioning of weakening demand is skyrocketing. If you go look at the Walmart, people did not like the Walmart answer at all. Now, Walmart, when you say is McDonald's, Walmart is steady Eddie. This is where widows and orphans put their money, and you get an 8% collapse in market cap in one day for one mention of a couple months worth of. People know the gig is up here, Phil. And I know I'm going to throw it back to you for these other charts, but this is becoming a roller coaster. And at the end, I want to talk a little bit about what the Fed and the Treasury are doing about this because it seems like panic is starting to, I'm smelling a sniff and a whiff of panic from the policymakers.
Yeah, so, and I think somebody else too, I think it was Burberry, they mentioned too, they were noticing they had a blurb this morning about consumer demand was way down from what they're used to seeing. So we're starting to see, and it's not only just like the low end of the spectrum in terms of the consumer base, it's also the high end as well. And I think we're starting to see this general contraction, despite what the headlines might say and despite what the market is doing, is that we're seeing, like, look at continuing jobless claims. I mean, the last time we were up at these levels was back in the first half of 2022. And as you guys recall, that was not a good time for the market. From March until about June, it was really volatile and we went down a whole bunch. Then we had a bounce and then we really made ultimately the lows of this cycle so far in October. So there's once you get to these levels, it introduces a lot of volatility. And then the other thing too that stuck out to me, Bob, was the manufacturing contraction in the PMI numbers. So while you could say, well, PMI is down, that's good for inflation. The fact of the matter is we've had an unprecedented amount of months. Well, I shouldn't say unprecedented, but quite a number of months where it's on par with when we run into economic hiccups. And if you look at 2008 and 2000, that's on par with recession. And it's obliterating even what we saw in COVID in terms of contraction. So I don't know how you can look at these numbers at this point and think that we're not rolling over into a recession. All that we're waiting for really would be just the actual traditional GDP contraction numbers and job numbers, which, jobs, I think, you can see the jobless claims. I mean, we're on a full-on contraction in terms of jobs there now.
Look, Xi Jinping came hat in hand to San Francisco, put on a smiley face and said, I want to be friends with the United States and we have no intention of going to war with anybody.
Yep.
They're worried.
Yep.
And make no mistake about it. And look what happened to energy today too. I mean, they're eviscerating because of storage demand coming into the year. Even though we expected November is usually a pretty weak month for oil and gasoline.
Right.
It's just throwing fuel on the fire, if I can have a bad pun, of this demand destruction that's coming out. And I think, Phil, it probably is too, I don't know how fast you can throw this RRP chart up, with the Fed liquidity, but Yellen just dumped $100 billion into the economy in just the last day, right? And RRP is being drawn down by the banks. So I think it's all hands on deck, full panic mode to get dollars into the system here because I think it's collapsing, Phil. still.
Yeah, so if we look at the net liquidity chart, let's transition over there. If you notice right over here on the far right, we're just jamming straight up in the air. We're back to liquidity levels. And so, this is what's kicked off the top of the market back in the beginning of 2022. We had this large reduction in liquidity. Part of that was the Fed turning off quantitative easing. The other one was Yellen was jamming up her balance, and the reverse repo wasn't absorbing it because she was issuing out a lot of long-term debt. Then if you look over here, what's happening now is she's jamming out a lot of T-bill issuance to try to combat the long-term debt issuance that she's been doing. I think we pick back up on the long-term debt auctions this week, or next week, I should say, and that'll start draining some of the liquidity. But she's jamming it. I mean, part of what jams this up is the treasury account, the checking account at the treasury. As they draw that down, it sends money out into the system, and this also creates a positive GDP momentum, which is kind of a false narrative because it's not really because of economic growth. It's because of debt allocation, which is sick, but that's just the way the numbers work. She drew down 100 billion yesterday, and that's a big outlier. It's usually not that big of a number. So I think that's why we may see a lag in what the stock market's going to do. I think they're desperately trying to get like a holiday lift generated. I think we're going to be volatile, Bob. I think we still have a pullback, but I think, it's going to be, if they're going to try to juice the markets, we're probably going to see a lift into December, into January. But it's kind of interesting because timing wise, that can backfire. And I think it will backfire. And I think when we get into January, I think we have a very real possibility of a very potentially violent move down into March. So we may get lulled into, some complacency here, but make no mistake, we're watching the markets every day, and Bob, the price action is getting really squirrely. The bond market's trading like an altcoin. The dollar's been trading spastically for a while now. Intraday, if you're looking at the higher time frame charts, it looked kind of sideways, but I can tell you intraday, the stock market was whipping around like a Mexican peso coin. There's liquidity problems under the hood. And one day we're going to wake up, I think, and we're going to have a really, really bad day down because a lot of this stuff, I think, is breaking under the hood, and they're doing all they can to try to keep it together right now.
Yeah, the only thing I would tell people that are listening is that you have to have a short hedge somewhere in your portfolio, because we will not get any warning on this. In 2018, there was a stock out there called XIV. It drove up during the day from like $96 to $103. And then at 10 after 5, started to sell. And by the time we woke up the next morning, it was a $12 stock. And then they delisted it because it was an unsecured credit. That's how fast these things can unwind if they get caught goofy-footed. And we're just really, really at the edge here. This is no joke. And here's the thing is, everybody's waiting for these flows to take us into January. But I'm here to tell you that they front ran a lot of that with the Janet Yellen QRA announcement in terms of the bond sales when she did, basically the Halloween massacre of the shorts. And there may not be enough energy in there to really have a meaningful lift. So we could potentially go sideways between now and January too.
Yeah.
People are waiting for this big lift. We may have just had it. So you got to be really, really careful here. And under the hood, you get rid of the Magnificent Seven. Commodities were a bloodbath. Shippers are getting blown up now, and a lot of things underneath the hood are not reselling. And you got to remember, before December 1st, you got to throw out all the stinkers so that people can get their capital losses for the year. So there's a lot of turmoil in the markets here. It's not going to be an easy lift from this point forward. And even if there is, you need to have a hedge. You have to suck it up, because you don't know if something's going to go wrong somewhere at some point. And I don't mean like a year from now. I'm talking about in the next 60 days, because these things just come out of the blue.
Right. So guys, let us know what you think. Are you guys feeling the slowdown in your area, in your neck of the woods? We'd love to hear your thoughts on that. Otherwise, we'll see you on the next episode. Please hit like and subscribe, smash that notification bell, set it to all, because it really helps out the algo with our channel. And always check out tradegenius.co for our specials. We have our Black Friday specials where you can get into the room with me and Bob. We'll help you navigate these markets with our tools and software and indicators. All right, guys, thanks a lot. Thank you, Bob. We'll see you on the next episode. Take care.
Trade Genius.